Let me start with a clear conclusion. December wasn't important because Tesla's stock went up. It wasn't important because of price cuts, and it wasn't important because of delivery numbers. December mattered because the way Tesla is being evaluated quietly changed. Hi, this is Ken. If you're still looking at Tesla mainly through monthly sales or short-term headlines, this month probably felt confusing. But if you understand what actually shifted in December, Tesla suddenly makes a lot more sense. Here's why this matters to you as an investor. If you misread December, you risk reacting emotionally to the wrong signals. But if you understand what the market is really watching now, you can stay calm while others overreact. In this video, I want to connect the dots. Why December news felt inconsistent, why bad headlines didn't break Tesla's valuation, and what long-term investors should actually focus on going forward. This is not a news recap. This is about how Tesla is being reframed. So first, let's quickly summarize what actually happened on the surface. In December, we saw multiple headlines hitting at the same time. Price cuts, especially around Model Y, weak delivery narratives in parts of Europe, regulatory and investigation headlines around FSD. And yet, despite all of this, Tesla's valuation didn't collapse. If you followed the news day by day, it probably felt messy. Good news, bad news, mixed signals everywhere. Naturally, many people asked, is Tesla doing well or is something breaking underneath? That confusion is exactly the point. Now let's slow down and look at why December felt so hard to interpret. If Tesla were simply a traditional automaker, December should have been ugly. Lower demand signals plus regulatory pressure usually mean sharp repricing. But that didn't happen. That tells us something important. The market wasn't ignoring reality. It was judging Tesla using a different framework than before. And this is where the idea of an evaluation axis becomes critical. An evaluation axis is simple. It's the question the market is subconsciously asking when it values a company. For years, Tesla's evaluation axis looked like this. How many cars are they selling? What are the margins? Is growth accelerating or slowing? Under that lens, price cuts feel scary. Delivery weakness feels dangerous. But December marked a shift. The market started asking a different question. Not how many cars did Tesla sell this month, but is Tesla's AI actually working in the real world? That's a fundamental change. And once that question becomes dominant, everything else moves to the background. Price cuts stop being a sign of weakness. They become a scaling decision. Delivery fluctuations stop being existential threats. They become temporary noise. The focus moves toward FSD maturity, real-world robustness, and autonomy scalability. This is why December felt contradictory on the surface. Old metrics were colliding with a new evaluation axis. And when you look at the month through that lens, something interesting happens. All those mixed headlines suddenly line up into a single story. In the next section, I want to dig deeper into what Tesla was actually optimizing for in December and why that matters far more than short-term numbers. Because once you see that, the rest of the month clicks into place. Now, let's go one layer deeper. If December wasn't about short-term sales, then what was Tesla actually optimizing for? The answer is simple, but often misunderstood. Tesla wasn't optimizing for margin per vehicle. It was optimizing for active vehicles in the real world. In an AI-driven autonomy model, scale matters more than short-term profitability. Every additional car on the road is not just a sale, it's a data-generating node. More cars driving, more edge cases captured, more real-world learning. From that perspective, December's price adjustments weren't defensive moves. They were offensive positioning, and this is where a lot of investors miss the point. Traditional automakers sell cars and move on. Tesla builds a fleet that keeps learning after delivery. Once autonomy becomes viable, the business model shifts from manufacturing to operation. A single vehicle can generate value every day for years. That's why the market didn't panic over December headlines. It was already looking past the factory gate. Now, here's the unexpected insight that stood out to me in December. During a major power outage in San Francisco late in the month, many infrastructure-dependent autonomous systems simply stopped. Meanwhile, Tesla vehicles running FSD continued operating normally. This wasn't about which system is better, it was about design philosophy. Some autonomy systems assume a perfectly structured world, constant connectivity, high-definition maps, stable infrastructure. Tesla assumes the opposite. It assumes the world is messy, unpredictable, and sometimes broken. That difference only becomes visible during abnormal moments. And December quietly gave us one of those moments. Markets notice that. This brings us to strategy. Tesla isn't just competing in software, it's integrating AI, hardware, and mass production simultaneously. While many AI companies try to solve reality purely with algorithms, Tesla actively removes physical friction through hardware innovation, lighting conditions, sensor limitations, manufacturing constraints. Solving AI in the real world means respecting physics, not ignoring it. This combination is difficult to replicate, and that's precisely why the market treats Tesla differently now. So, what does all of this mean for investors? It means the old reflexes no longer work. Reacting emotionally to monthly delivery numbers or short-term pricing headlines can pull you away from the bigger picture. The real signals are quieter. Where is FSD improving without fanfare? Which regions are moving from testing to preparation? Where is Tesla choosing patience instead of hype? December showed us that Tesla is transitioning from a company talking about the future to a company quietly entering it. Looking forward, this trend only accelerates. The next major re-rating won't come from a flashy announcement, it will come from operational proof, from moments when autonomy simply works and people stop talking about it because it feels normal. That's when business models change, and that's when long-term value compounds. So let me leave you with this thought. When you look at Tesla news from now on, ask yourself one question. Am I looking at this as a car company headline or as a signal about real-world AI maturity? That single shift in perspective changes everything. That's all for today. If this breakdown helped you see Tesla more clearly, feel free to leave a like. And if you're interested in calm, long-term analysis beyond daily noise, consider subscribing. Thanks for watching and enjoy life with Tesla. Before we wrap up, let me take a moment to introduce myself. I drive a Tesla Model Y, and at home, I've installed a Tesla Powerwall, so I actually charge my car with solar energy. I truly believe Tesla is shaping the future, and that's why I share the latest news and insights here on this channel. I'm from Japan, but I want to connect with Tesla fans all around the world. That's why I also create an English version of my videos. YouTube now lets you switch the audio into your own language, so you can enjoy it in whatever language you prefer. Most of all, I'd love to connect with Tesla fans everywhere so we can support Tesla together. I also share updates on X, so feel free to follow me there and let's connect. And if you haven't already, please subscribe to this channel. I'd really appreciate it. Thanks for watching, and I'll see you in the next video.